Every retiree should review one of three different tax strategies to ensure that they're getting the most out of their retirement years. And today we're going to use Elizabeth and Joe as an example to walk through their plan and how implementing each of these three things allow them to get more out of their retirement. Now, Elizabeth wrote in worried about retirement. She's excited for her husband Joe to retire so they can go to a retirement community and really enjoy their time together. But she is concerned about the tax efficiency of their withdrawal strategy, knowing that if they get that wrong, that could cost them thousands and thousands of dollars over time. So tune in as we show how the right tax strategy could potentially add hundreds of thousands of dollars or more to their plan and what you can do to implement this in your strategy as well. So what we're going to cover today is the asset location strategy, the withdrawal strategy, and the Roth conversion strategy that everyone should at least look at when it comes to their retirement plan. Now, we're going to use Elizabeth and Joe as an example of how to walk through this and how to apply this to your situation. But these three things, getting your asset location right, getting your withdrawal strategy right, and getting your Roth conversion strategy right, every single person who's retiring should be looking at these. And I'm going to show you exactly what I mean by that as we walk through Elizabeth and Joe's situation. So here's Elizabeth and Joe's portal. As you can see, Elizabeth is 53, Joe is 51. And when we look at their net worth, they have about $4.2 to $4.3 million in combined net worth. Some of that is in the bank. Some of that is credit cards. They have about $2.2 million in investments. And as you can see here, some of these are just taxable accounts. So the E-Trade account here, about $525,000. Then they have IRAs and 401ks, Roth IRAs, but combined, they have about $2.2 million in retirement investments. Beyond that, they have their primary home worth about $1 million, and they have a lake house worth about $1.2 million. They do still have a mortgage of $175,000 left, but that's a snapshot of the assets they have. And what they're wondering is, can we retire? And when we do retire, can we make this tax efficient? We don't want to retire and overpay in taxes because every dollar that we overpay is one fewer dollar that we get to spend on doing things that we want to do. So let's look at what they do want to do. Well, they want to retire in 4 years. Joe is 51. He wants to retire at 55. Elizabeth is already done working, but what we're planning on is another 3 to 4 years of work for Joe. So when they do retire, here's what they want to spend. They want to be able to spend $8,000 per month. And this is after property taxes. This is after federal taxes. This is after the mortgage. This is after all these other goals. $8,000 per month is the goal that they have. Curious to know, do you think that they can do this? Can Elizabeth and Joe retire on the assets they have and afford to spend $8,000 per month? We're going to see, but want to know your thoughts as well. In addition to this $8,000 per month, they have healthcare costs. So they're covered by Joe's healthcare plan today through work, but when he retires, that goes away. So we're planning on another $6,000 plus per year for each of them throughout retirement. We're planning on some long-term care costs. We want to plan on a one-time country club expense here. And then there's a wedding that they potentially want to be able to fund here as well. So right now there's a zero here, but we're going to look at, can they fund their needs first? And then they can back into ability to fund other things as well. And again, we're taking an eye towards, can they do this in a tax efficient way? Yes, can they retire and meet these needs? But how do they do so in the most tax efficient way? Here's the income sources that they have. So Joe is still working. He has a very healthy salary of $400,000. Once they do retire, they'll have Social Security. Social Security for Elizabeth will be $1,629 at her full retirement age. If she waits until age 70, she'll get 3 years of delayed retirement credits, which will increase that. Joe's Social Security benefit at age 70 will be about $4,800 per month. So there may be some spousal benefit stuff that we can look at, but those are their Social Security benefit amounts. Savings. So they're not fully retired quite yet. Joe's still saving 15% to his 401k. And then on top of all that, they're saving $120,000 per year to their E-Trade taxable account. So these are their savings. These are their income sources. These are their goals. This is the snapshot of where they are today. What we want to know is, how can they make retirement as tax efficient as possible, knowing they have IRAs, they have 401ks, they have brokerage accounts, but they're saving a significant amount too. They have Roth IRAs. How do they tie this all together to ensure they're saving the most amount possible in taxes so they can be freed up to spend the amounts they want to spend on the things that matter to them? So to understand that more fully, we're going to go to the retirement cash flows page. On their cash flows page, what we see here is all their different income sources today and throughout retirement. Compare that to all their different expenses throughout retirement. So today we know they have healthy income coming in that meets all their needs. What we really care about is as soon as they are both retired. Elizabeth says she's looking forward to Joe retiring so they can go join the retirement community, cherish the time that they have together, and just start living as opposed to having to spend so much time working and, of course, preparing for their retirement. When that happens, obvious to say, salary goes away, income goes to zero. Now, income picks up again in the future when their Social Security benefits kick in, but there's a significant gap here. What we want to know is, can they meet all the different expenses they have? So living expenses, this is the $8,000 per month, $96,000 per year in today's dollars, but adjusted for inflation. So $96,000 per year today, that increases, of course, by the time they retire, closer to $105,000 and rising with inflation. Then they have housing. So here's their housing payment, and you can see their house will be paid off about 2031, but there's still going to be expenses beyond that because they still have property taxes and they'll still have insurance. So here's a summary of what their housing costs will look like year by year throughout retirement. Then they have healthcare. So here's an assumption of what we're putting in for healthcare. Obviously, healthcare expenses can change quite a bit in retirement. So as you're doing your own planning, make sure you really lock in what you think that might look like. And then they have the costs of the vacation property here as well. So these are their total expenses. Now you see one of these columns is called tax payment, and we're showing $0 in tax payments going forward. The way I'm modeling this out to start is they have all their retirement assets, brokerage accounts, Roth accounts, 401ks, IRAs. The question, of course, and the thing that's going to determine how much do they actually pay in taxes is, what order are you pulling assets from? Well, for the first few years, I'm going to assume that they're pulling money from the brokerage account. And the reason for that, of course, is they're under the age of 59 and a half. So they don't have full access to some IRAs or 401ks, depending on the timing of exactly when they both fully retire. So I assume brokerage account fully from retirement age until 59 and a half. And then from then on, I'm assuming a pro rata withdrawal. So if you need, for example, $185,000, and hypothetically, if their Roth was half of their account and their traditional IRA was half of their portfolio, they would take half this amount from the Roth, half the amount from the IRA. Now the Roth isn't half and the IRA isn't half, but whatever the makeup is of their overall portfolio, they're drawing proportionately. I'm not necessarily saying that's the way that they should do it, as much as that's the way we're modeling out first to start, so we can compare different alternatives and see which is most effective for them. So as we go through this, we can add up every year, what are their expenses, which is a combination of core living plus housing, plus healthcare, plus rental and vacation home maintenance, plus taxes. Here's those total outflows. This is the total amount then that they need to take from their portfolio so they can pay any amount in taxes that we're modeling out here, and then have enough left over to meet this need, which means they can pay for the rental home, healthcare, housing, and then finally the equivalent of $8,000 per month in today's dollars. So once we have this, I could go through a full-blown retirement analysis to show you, can they make this work? Are they on track? But I'm just going to cut to the chase here so we can go over some of the tax stuff. They look to be in a pretty good position. Now, this is making some pretty big assumptions. The first of which is that Elizabeth and Joe will get an 8% per year growth rate going forward on average. Not every single year, but an annualized return of 8%. That's a fairly high growth rate. And all we're doing is we're taking the mix of assets that they have today, looking at the historical return, adjusting it down a little bit, and then projecting that going forward. So I wanted to say a big disclaimer here. There may be some shifting of their retirement asset allocation. There may be some things that they're doing. They may not get that growth rate. So this is by no means a guarantee, of course, as much as it is to say, if you keep your current asset mix, which would be one of the questions, what will that look like for you? And again, full disclosure, Elizabeth and Joe are not clients. This is just a question that we're going over, but I did want to point out what we are assuming as part of this process. So if they get that growth rate, as you can see here, their retirement looks pretty darn good. They're able to do everything they want to do, and their portfolio just keeps growing over time. Probability of success, 68%. Not horrible, not the best, somewhere in between, probably something that we can revisit. But what I want to look at now is what tax strategies exist. Because if you recall, one of the things I said is that they're going to pull their funds out pro rata. So depending on the makeup of their IRA, Roth IRA, brokerage account, we're going to pull funds to meet their income needs. We're going to model it out this way, I should say, in that manner. But that doesn't necessarily mean that's the best manner. So let's actually take a look at some different options for them to see which makes the most sense for them. Now, as we look at this, I do want to be very clear that this is specific to Elizabeth and Joe, these specific numbers, but these principles are true to all of us. So pay very close attention to what we're going to look at here, because there's going to be some principles that you can absolutely apply to your own situation. There are three different things we want to look at here. The three different checklists of what is your asset location, what is your withdrawal strategy, and what is your Roth conversion strategy. Every single retiree should at least look at these. Even if it doesn't end up making sense for them, these are things that they should be looking at. So let's start with asset location. What does asset location mean? Well, it means, let's assume that you have an 80-20 mix in your portfolio, 80% stocks, 20% bonds. What a lot of people do is they simply put an 80-20 allocation in their traditional IRA, an 80-20 allocation in their brokerage account, and an 80-20 allocation in the Roth IRA. Not the best way to do it in most cases. And so what you can see here, this is specific to Elizabeth and Joe. Right now, their overall allocation is about 78% stocks, 22% bonds when you look at their portfolio as a whole. And the way it's spread out is in their taxable account, they have about 72% stocks, and the remaining 28% is bonds. And in their IRAs and 401ks and in their Roth IRAs, it's about an 80-20 allocation. So this is how they are today, but let's explore some alternatives. One being, what if they were a little bit more intentional with how they allocated their funds? What if they put all stocks in their Roth IRA? Why would we want bonds in a Roth IRA when bonds aren't going to be the things that grow our portfolio the most over time, assuming that we aren't going to tap into our Roth IRA for a long period of time? What if we put some of the tax inefficient investments into our tax deferred accounts? We're not paying taxes on that interest or on some of that tax inefficient growth. So that might be a good place to put things in your IRA or your 401k. And then the taxable account, how can we be smart with that to make sure that the tax efficient assets are held there? What does that mean? It means you have the same overall portfolio allocation, but if instead of distributing that evenly, you're a little bit more intentional with that, what you can see is you can gain a lot more in terms of your tax adjusted ending assets, all assumptions still being equal, pay a lot less in taxes, and have fewer withdrawals from tax deferred accounts. So that's a pretty significant savings right off the bat. When you start looking at the comparison of what do things look like if you make no changes to what if you become a little bit more tax efficient. So point number one for Elizabeth, as she asks, how can we make this more tax efficient? Start by taking a look at your asset location. That goes for Elizabeth and Joe, and that goes for all of us. Really getting the asset location dialed in can make a huge difference over time. So that's the first thing. The next thing that we want to look at is the withdrawal strategy. Now, the withdrawal strategy that we modeled out at the beginning is a pro rata strategy, pulling evenly from IRAs, Roth IRAs, and brokerage accounts. Typically, it does not make sense to employ that strategy. Occasionally it does, but many times it doesn't. And to illustrate why, here's what we're going to do. So this is the proposed strategy. So this is just the impact of getting the asset location right. That's why this number is $1.2 million. But what you're seeing here is this blue bar, this blue line here, this is showing you what their projected taxable income is going to be starting today when income is about $400,000. Then they retire. What might their taxable income look like over time? And then we're overlaying different tax brackets on top of that to give a sense of what tax bracket might you be in at different points along the way. So what we're going to look at now is what if they don't just take a pro rata withdrawal sequence, and try to, in your mind, keep track of what this looks like here. Here's the purple line. You see it's high, then it drops off a little bit, then it bumps up more, then down, then up. So a few different things happening there. Well, what happens if instead we have a withdrawal sequence of take from taxable accounts first, then tax deferred, so IRAs and 401ks, and finally tax-free? How will that impact this? We'll keep this number in mind, 1.26 million. If we refresh this, now all of a sudden you're adding even more wealth to your tax adjusted ending assets than the starting strategy. On top of that, you've created a bigger, what we'll call tax planning window. So this is a gap here between these purple bars. This gap is the gap between income being high at $400,000 per year when Joe's still working, to it then drops off. And if they're pulling money from their brokerage account first, their taxable income is staying very low. And then it pops back up again once they start spending from IRAs again, because they've spent down the brokerage account or because other reasons are causing them to spend their IRAs. But you have a big tax planning window, which ties into our third tax planning strategy, which is the Roth conversion strategy. Now, by the way, as we're looking at this, I get a lot of emails from people saying, is this software available? Yes, is the answer. It's available in our Retirement Planning Academy. You can access that in the link below. You get all these different modules. So if you want to go through this with your own numbers, be sure to check out the Retirement Planning Academy and you can do so. But finally, the third strategy that we want to look at after asset location, after withdrawal strategy, is then the Roth conversion strategy. And as you're watching, it is really important that you do things in this order, because your equity allocation and your withdrawal strategy help us understand what your taxable income might look like at different years based upon the tax efficiency of your assets and based upon the way that you're going to withdraw those assets. But once we have this, then we can start to understand what does it look like to fill up different income tax brackets. So I'm going to say, what if you fill up the 10% bracket here? What does that do? Well, now all of a sudden, the proposed strategy, the difference between what we started with and what we're doing now with three relatively simple changes leads to $3+ million in tax adjusted ending assets compared to the original strategy. What does that actually look like here? Well, here was the original projection of taxable income. Here's the new one. And what they're doing is they're saying, instead of paying taxes way down the road at a much higher rate, can we, in those gap years, in the tax planning window, can we pay enough in taxes, or can we shift enough from our traditional IRAs to our Roth IRAs to start putting that money to a tax-free account and paying taxes at a very low rate? Does that make more sense? And the answer is absolutely yes. So when you start to combine these different tax strategies, this is what tax efficiency looks like. By having the right asset location strategy, withdrawal strategy, Roth conversion strategy, it's really making a significant dent into what they're able to do with their retirement. So what we want to look at next is, does it make sense to stop there? This was after converting 10% or converting up to the 10% bracket in the year they were able to. That's almost $3.2 million. And one of the things that's unique to note about Elizabeth and Joe is they're retiring early. So they have a lot of years that they can do this. And so what that means, practically speaking, and this is more unique to them, this isn't going to be as common for everyone else. But if I said, well, let's keep going, let's fill up the 12%, which will soon become the 15% bracket, instead of just a 10, that actually starts to cost them in terms of what this number could have looked like. So for Elizabeth, for Joe, under these assumptions, the sweet spot really was right here of, can they fill up the 10% bracket? In doing so, that adds a lot of money to their tax-adjusted ending assets as compared to the reference strategy, when they also have the right asset location strategy and withdrawal strategy. Now, what's the point of all this? Is the point of all this just to say, great, now you have another $3 million that you can die with at the end of the day? Or is the goal of this to say, what can we do with that? Can we look at that and say, this is going to help with our estate planning in the way that we ultimately want to transfer assets to our children in a more tax-efficient manner? Or do we look at this and say, you know what, this is great. Can we spend more? Can we retire earlier? Can we make other adjustments to our plan because our tax strategy has allowed us to recoup this much more money in our portfolio that we can direct elsewhere as part of our planning? Or do you say, you know what, this just creates peace of mind. This strategy helps us to know that when we are in our later years, and our 80s and our 90s, we know that there's more tax-free money, that if there was a major health event, if there was a major expense, we could pull that out without significant tax impact. All those are very valid things, but what we want to do is we want to come back to the retirement plan and then plug this in. Don't just do tax strategy just to say, great, now you can die with a lot more money. We want to plug this in to say, what would this look like with the tax proposal? Rerun that plan. And when you rerun that plan, you see as more dollars at the end of the day. Those dollars mean that we can then start to look at things like, Joe, what if you didn't work until 55? Could you retire a little bit sooner? Or maybe that doesn't work, but what if you could spend more than $8,000 per month? Or if you recall, there was a wedding goal. Can we add some money, or can we help out with the daughter's wedding that wasn't included in this plan? But knowing all this, does this then change what we can do for our daughter? So that's really the essence of financial planning. We don't do this tax strategy just to say, great, now there's more money you can die with when you're 90 or 100 years old. We do it so we can then look at your plan and say, what can we now make better? How can life look better because of the tax strategy and the savings that we were able to recoup along the way? So yes, right now we're specifically looking at this for Joe and for Elizabeth. But the takeaway for everyone watching is to understand, what's your asset location strategy? What's your withdrawal strategy? What then is your Roth conversion strategy? If you can get those three pieces dialed in, it's going to create a much more efficient overall tax strategy that may allow you to enhance other parts of your retirement. Root Financial has not provided any compensation for and does not influence the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.